Welcome to another BAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over BAR Area 3. This is Section C6. This is an application topic. Calculate the amount of non-exchange revenue to be recognized by state and local governments using the modified accrual basis of accounting and prepare journal entries. And if you watched the previous video, we talked about something very similar, but we talked about the accrual basis of accounting. Now we're talking about the modified accrual basis of accounting. And we're going to be doing all this the SuperfastCPA way, which is diving straight into the questions to learn the material. If you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. You'll learn a lot in just that 1 hour for free. We'll teach you the key ingredients to passing the CPA exam. And then from there, you'll probably want to learn more. So make sure you also check out the pro course or getting our supplemental study materials or getting the total bundle, which includes all of our products. One last thing before we dive into the questions is just to let you know, today's video, we're only going to be going over 5 questions for the YouTube version, but people who are a part of SuperfastCPA, currently people who have the pro course, and it will eventually switch to people who have these supplemental study materials. Again, those are the people who will get access to the full versions of these videos, which are usually 10 questions long, so that they can get a little bit more help and a little bit more understanding. So if you like this, make sure you, again, check out becoming a part of SuperfastCPA. Now with all that, let's dive straight into the questions. Okay, here we are at question 1. Again, in the last video, we talked about the non-exchange revenue when it came to the accrual basis of accounting, but now we're doing the modified accrual basis of accounting. So we're just kind of expanding on it. Basically, it's very similar, but we're going to talk about the things that are different in this video. So everything you learned in the previous video, a lot of it applies, especially the 4 different kinds of non-exchange revenue. But in this video, we're focusing on, of course, the modified accrual approach. So let's go through this. One thing that I always like to point out is reading the last sentence of the question first. This is a very good tip, a very good idea, especially for exam day, because that will frequently give you context for what the question is really about. And then you'll be able to read through the rest of it and understand things more clearly. So let's do that here. How much property tax revenue should the city recognize in its general fund for the fiscal year ended June 30th, year 1? Let's go up to the top. A city levied $1,028,000 of property taxes for the fiscal year ended June 30, year 1. All of the taxes were considered measurable, and the city used a 60-day availability period. The taxes were collected as follows. Collected by June 30th of year 1, $720,000. Collected during July of year 2, $138,000. Collected from August 1st through August 29th, year 2, $74,000. And collected after August 29th, year 2, $96,000. All right, so this might be the first time that you're really dealing with this. So if you don't really know how to approach this or really know how to calculate this, that's okay. We are using these questions to learn the material. So let's go ahead and look at the answer to start learning what is recognized out of all these numbers. Okay, here we are. The answer is C, $932,000. So let's go through this. It's pretty straightforward. Property taxes are imposed non-exchange revenues. We talked about that in the previous video. Imposed is things like property taxes and fines and penalties. Because all the taxes were levied for year 1, as in they were like created or asked for in year 1, they meet the time requirement for recognition in that year. However, under the modified accrual basis, the taxes must also be measurable and available to be recognized as revenue. So let's keep reading. The city recognizes the $720,000 collected by year end, obviously, the $138,000 collected during July, and the $74,000 collected through August 29th, because all of these amounts were collected within the city's 60-day availability period. So you add them all up together, and that's $932,000. The remaining $96,000 is measurable but not available because it was collected after the 60-day period. Therefore, it is reported as a deferred inflow of resources rather than as revenue for year 1. So under modified accrual, we are recognizing things during the availability period. Very frequently, it's 60 days, by the way. In fact, you can probably usually assume 60 days unless stated otherwise. If there's a question that says a different availability period, then follow that. But a lot of the time, you can probably assume 60 days. We were told 60 days in this question. And again, anything that was collected before year end or even 60 days after year end counted as being recognized for the revenue. The $96,000 was after the 60 days, so it's not counted. So we learned a little bit about the modified accrual basis for non-exchange revenue. Now let's go to the next question. Okay, here we are at question 2. Again, reading the last sentence first. How much of the property's taxes meets the availability criterion for recognition as revenue in the city's general fund for year 1? Let's go up to the top. At June 30, year 1, a city had $685,000 of measurable property taxes receivable that were levied for the current fiscal year. Of this amount, $520,000 was collected within the city's 60-day availability period. There's that 60 days again. Usually you're probably not going to be told 60 days, but I'm kind of doing that throughout this video to get that number into your head. That's the usual number that you can probably assume unless told otherwise. The remaining $165,000 was collected after the availability period. So again, how much of this meets the availability criterion and is recognized as revenue? Based on what we learned in the previous question, you can probably think your way through this, or you might already know the answer. If you want, pause the video, do this, and when you're ready, come back, we'll look at the answer together. All right, here we are. The answer is B, $520,000. Again, that probably was not too difficult based on what we learned in the first question. Under the modified accrual basis, revenue must be both measurable and available. Revenue is available when it is collected during the current period or soon enough after year end to pay current period obligations. The $520,000 collected within the city's 60-day availability period meets the availability criterion. The remaining $165,000 does not meet that criterion because it was collected after the availability period. That's pretty easy, pretty straightforward, even though it was measurable and levied for the current fiscal year. So when it comes to modified accrual, it's not just about when it was levied or if it's measurable, it has to also be available, which is during the current fiscal year or within the availability period. Now with that, let's go to the next question. All right, here we are at question 3. How much sales tax revenue should the city recognize for year 1? Let's go up to the top. A state collects a combined 8% sales tax on behalf of itself and a city and remits the city's share to the city within days of each collection. Of the combined rate, 6% belongs to the state and 2% belongs to the city. The city reports its sales tax revenue in its general fund using the modified accrual basis and has a 60-day availability period. The state collected the following amounts from taxable sales that occurred before the city's June 30th year 1 fiscal year end and remitted the city's share as indicated. So they collected by June of 30th, $758,400, collected within 60 days after June, $288,600, and collected more than 60 days after June 30th, $132,000. So how much sales tax revenue should the city recognize for year 1? Now, honestly, this is something that when I was kind of researching this and learning this, did not come intuitively at all. But once I learned it, it's actually really straightforward and really easy. So if you have no idea what you're even supposed to be doing here, that's okay. If you have an idea, maybe pause the video, but let's go ahead and go to the answer when you're ready. All right, here we are. The answer is A, $261,750. Again, this is something that probably didn't come naturally or intuitively to you. So let's go through this so that you can kind of see how you were supposed to do it. The city recognizes its share of the sales taxes collected by year end or within its 60-day availability period. The combined tax collections considered available are $758,400 plus $288,600. So we only combined the one stuff that was collected before June 30th and within 60 days after June 30th. So the total is $1,047,000. The city's 2% tax represents 1/4 of the combined 8% tax rate. So if you do 2% divided by 8%, that's 1/4. Multiply that by $1,047,000, and that gives you $261,750. So again, to me, that didn't come naturally until I saw it, and then I was like, oh wait, that's how it works. So the thing that caught me was I didn't understand what these numbers really represented, but when you think about it, they collected 8% sales tax, but that means the 8% sales tax totaled to all these numbers. So 8% sales tax meant that the collected sales tax was $758,400 by June 30th. That is 8% of whatever the sales were. So don't get too confused about the 8%, the 2%, the 6%. These are the actual numbers. And then all we need to know is out of that 8%, which again is the full total, how much of it belongs to the city? 2% of 8%. So, that's a quarter, or 2 out of the 8, which means it's a quarter, 25%. I hope that makes sense. It's really not too difficult once you understand. Again, the 8% is not a percentage of these numbers. These numbers came from, the full number is the 8% sales tax. And then that's when we're kind of dividing it. So 2% out of the 8% is 25%, or, a fourth of $1,047,000. So I hope that made sense. The $132,000 collected after the availability period is excluded from year 1 revenue. That one's pretty straightforward. Although the taxable sales occurred before year end, that amount was not available under the modified accrual basis. Again, it has to be available, it has to be within the availability period. So again, this is a type of question that might not have come intuitively to you, but now that you see it, really all it's about is making sure you know the total amount of sales taxes that are recognized, and then you can figure out how much of it goes to the city and how much of it goes to the state based on their percentages out of the total percentage. So it's not 2% out of 100, there's 8% total, and 2% of that 8% is the part that goes to the city. So I hope that makes sense. Now let's go to the next question. All right, here we are at question 4. How much grant revenue should the city recognize in its governmental fund for year 1? Let's go up to the top. A state awarded a city a reimbursement grant that covers 75% of eligible emergency shelter costs incurred from April 1st, year 1 through March 31st, year 2. The city's fiscal year ends June 30th, and it uses a 60-day availability period. By the way, again, throughout this video, I've been saying that, but you're usually not going to be given that because usually you can assume 60-day availability period is kind of the general number that's used. So usually think 60 days, unless told otherwise. The city incurred the following costs. Before April 1st, year 1, $72,400. From April 1st through June 30th, year 1, $386,000. During July, year 2, $84,000. The city was entitled to reimbursement of $289,500 for the costs incurred from April 1st through June 30th. Of this amount, $231,600 was received within 60 days after year end, and the remaining $57,900 was received later. So how much grant revenue are they going to recognize? There's a lot of numbers, kind of a lot going on here, but at the same time, if you slowly read through it, I think you'll probably be able to figure out the correct answer fairly easily. So pause the video, think through this, and when you're ready, come back. We'll look at the answer together. All right, here we are. The answer is D, $231,600. For a reimbursement grant, the city meets the eligibility requirements when it incurs allowable costs during the period specified by the grant. This is something we talked about a little bit in the previous video, where voluntary non-exchange revenue, like a grant, has to have the contingencies met for the revenue to be recognized. And that's the same thing here, even though we're talking about modified accrual. So it only can have the eligibility requirements, means that it has to incur allowable costs during the period specified by the grant. Therefore, only the $386,000 of costs incurred from April 1st through June 30th qualifies for consideration in year 1. $386,000 multiplied by 75% equals $289,500. However, governmental fund revenue must also be available under the modified accrual basis. Only the $231,600 received within the city's 60-day availability period is recognized as year 1 revenue. The remaining $57,900 was received too late and is not recognized as revenue for year 1. So that one could have caught you. If you didn't remember, we were dealing with modified accrual accounting. I hope that helps. Now let's go to the next question. Okay, here we are at question 5. Now, this is kind of a big question. It's essentially combining a lot of the things that we've learned so far into one question. So, kind of a big thing to read through. So this time, I'm expecting you to read through it because, again, you need to carefully read through this, see all the different pieces of it, and try to do this. This is the 5th question. We've learned a lot so far. I think you probably have a chance at doing pretty good at least having a decent guess. So pause the video, work through this. I will read the last sentence so you can be thinking about it, but you read through the rest. What total amount of non-exchange revenue should the city recognize in its governmental funds for year 1? Okay, again, I'm expecting you to do it. So pause the video, come back when you're ready. All right, here we are at the answer, B, $877,000. Now, hopefully you got that, based on everything we've learned so far in the video, but let's go through it. The city recognizes only the amounts that meet the applicable recognition requirements and are measurable and available under the modified accrual basis. Property taxes, $485,000. Sales taxes, $272,000. State grant revenue, $120,000. So add that all up together, $877,000. The property taxes, sales taxes, and reimbursement grant amounts collected after the 60-day availability period are not recognized as year 1 revenue. The $90,000 future period grant is also excluded because its time requirement has not been met. Receiving the cash before year end does not make it year 1 revenue when the resources cannot be used until year 2. So hopefully that question kind of helped wrap some things up or helped you kind of put everything together from what we've learned so far. Now, we've gone through 5 questions. Let's do one more part of the SuperfastCPA process called Pillar Topics. Now, as a reminder, the idea behind Pillar Topics is as you're going through the questions in your review course to learn the material, you will notice the things that keep popping up throughout the questions. The same concepts, the same topics. For example, you might see multiple questions that have you split out the sales tax for city and state, like we did in that one question with the 8% and then the 2% and the 6%. You might see something like that, or you might see something else. Overall, the important thing is you're noticing the key things that you're learning from the questions, and you write them out in your own words as the pillar topics, essentially the most important things you learned consistently throughout the questions. Now with that, let's go to the pillar topics for this video. All right, here we are at the pillar topics. Let's go through this. Again, the idea here is these are essentially the summary, the key points that we learned from those questions. So let's go through this. Non-exchange revenue is recognized in governmental funds only when the applicable recognition requirements are met and the revenue is both measurable and available. And remember, we're specifically talking about modified accrual in this video. Revenue is available when it is collected during the current period or soon enough after year end to pay current period obligations. The government's established availability period determines how long after year end collections may still qualify. Usually 60 days, but don't always trust that that's always the case. Make sure you read and carefully make sure that it's not, it doesn't say something else. An amount can meet its normal time or eligibility requirements without qualifying as revenue under modified accrual. If it is measurable but unavailable, it is generally reported as a deferred inflow of resources. For reimbursement grants, eligibility is established when the government incurs allowable costs during the permitted period. The related revenue must also meet the availability requirement to be recognized in a governmental fund. And then finally, when a state collects a combined tax for itself and a local government like a city, the total available collections must first be divided according to each government's share of the combined tax rate. Now with that, we've gone over the pillar topics and the first 5 questions for this video. Remember, in the YouTube version that you're watching right now, we're only doing the 5 questions and the pillar topics, but if you liked this, make sure you check out becoming a part of SuperfastCPA because you can get access to the full 10 question versions of these videos if you right now become a pro member, but in the future it will be from purchasing the study materials. Or of course you can get the total bundle, which has everything, and then you'll for sure get it. So make sure you check all that out, and the easiest way to do that is by going to SuperfastCPA.com and signing up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam, and then again, that will give you a good path to learning more about SuperfastCPA. So with all that, I hope this video was helpful. Thank you for watching, and I will see you in the next one.